is AI eating the economy? If you be forgiven for looking at this graph and saying that AI is eating the venture capital space, but we don't think that's necessarily a bad thing. In fact, as Cameron will get to at the end when we talk about our alternative themes, where we have conviction, it is in venture capital where we think there's great opportunities. A lot of those opportunities are tied to AI, but you can see the diminishment in a lot of the other types of what have been very kind of hot places for venture capital, whether it's crypto or software. Those have really receded and given way to this very powerful AI story. Let's dig into the economic data and what I think may be the chart of 2025 so far. In the first 2 quarters of the year, the quarters that we have data for, contribution to overall GDP growth, which has been about 2% if you look at the core growth, it's been about equal between consumers, who are usually the overriding contributors to economic growth, and spending on computers and software, which has really started to come up. There's not a lot of volatility in this graph, but you can see that this contributing 1 percentage point to GDP growth for this relatively small, normally, share of the overall U.S. economy is punching way above the usual weight class. And with the fact that these two things are contributing about the same to overall GDP growth is very unusual. It's usually only during recessions when consumers are actively pulling back on spending that you have equipment and software spending kind of contributing more than overall consumption growth. In this case, they're contributing about the same amount, but as we've already covered, a lot of that consumption may be implicitly backed by optimism around AI that's powering the equity market, which again is powering consumers. So there's a lot of AI on this graph, even in the places where it doesn't seem like it. What has been happening in the last couple of years, really from 2022 through the middle of last year, was you had this really powerful explosion in factory building, construction for manufacturing structures. And that was on the back of the CHIPS Act. Now, what was going to have to happen, as Jay alluded to, is we're going to need a lot more construction, not only at AI data centers, but other things to power those data centers. We're including power and electricity on this graph as well to show that these were basically growing in line with that factory growth up until the CHIPS Act. And then the factory growth sort of exploded. Now, what's happening now is it's no longer contributing to growth. The building out of factories is receding somewhat as other things are coming online, like data centers. We're switching what kind of things we're spending money on in terms of the construction. The absolute level of factory construction is still high, but it's not contributing to growth anymore. You can see really well in this next chart exactly what the timing was of this explosion. It was right after the passage of the CHIPS Act. Factory construction was already on the rise, but it really took off after the CHIPS Act. We obviously haven't had a similar legislative effort to try to get more data centers built or more power built. That may happen at some point. But what's important to note here is that the thing that's going in as an input to these data centers, the computers that are powering the data centers, those are currently not subject to tariffs, where a lot of the things that are going to be inputs into a lot of other types of manufacturing are. So if we kind of go where the money is and go where sort of the cheapest input costs are, companies are not having to pay tariffs to import the parts that they need to power the data centers. And that's not true of other factories, like, for example, auto factories. Let's talk about where we're seeing the construction in non-residential investment. So this is the amount of construction that's being built by sort of the purpose of the structure. You might be really surprised, I know I was, to see offices still so high. Came down after COVID for very understandable reasons, but still kind of the dominant structure in terms of new construction in the United States. But it's really the data centers that are the standout on this graph. The only place where you're seeing growth in non-residential construction is in the construction of data centers. We should also be seeing eventually those electricity and power generations come online as well, usually in areas where the data centers are. And let's talk about the residential construction sector as well. This tends to be a contributor to the economy early in a cycle and then tends to recede as you see things like rising interest rates and as people become less likely to move. This cycle has been very, very different, though. We had this huge boom in construction coming out of the pandemic, and that gave way to now historically low level of home builder confidence and a plummeting level of building permits for single family and multifamily homes, as builders simply look at the environment where we're seeing home prices falling in a lot of areas of the country, where financing is still very, very expensive in many places. Mortgage rates still well above where they were, obviously pre-2020, and are just simply choosing not to build. So a lot of the economic activity that would be happening is not happening, and it's being sort of replaced or taken up by more investment in this one very kind of narrow area of the economy related to data centers and AI power generation. So this is a very unusual circumstance as we get to the labor market now. We are seeing very powerful growth in investment in equipment, which we've covered, I think, in detail here thus far, but really nothing in the way of new hiring. Whether you're looking at the public sector data, private sector data, a lot of that's come online since the government shut down. A lot of private sector data sources all of a sudden springing up and telling us the same story that we knew already, which is private payrolls are not growing in any meaningful sense. And this is a very unusual circumstance. You can take this graph all the way back to the early 2000s. It's hard to find a time when you had a lot of kind of really powerful investment happening, but you had hiring getting pulled back. So I think what we can say is that AI is an unusual type of investment in that it doesn't necessarily lead to job creation, but we are also seeing evidence that the inflation related to electricity costs, the consumer price inflation category just for electricity, may be higher and persistently high because there are new sources of demand for that power springing up all over the country. And that could be pushing up electricity costs, or at least keeping the rate of increase in those electrical bills that we're all getting higher than it would be otherwise. We're nowhere near where we were kind of post-pandemic when there was a huge surge of demand and inflation across many, many different sectors in the economy. But the fact that we haven't seen this one normalize to any significant extent tells us there could be something else going on. It could be related to data center power demand. Talk about the labor market as it relates to the consumer. This is where we think the most important potential crack is forming in the economy, is that consumers' assessments of the labor market have just been getting worse and worse. This black line here is telling you the difference between how many consumers are reporting jobs as plentiful versus those reporting jobs as hard to get. And that's been getting worse pretty steadily now for a few years, but especially in the last couple of months, that has historically been associated with higher unemployment. Consumers are quite good at taking the temperature of the labor market. And one of the things they're telling us right now is the labor market is getting worse, and they expect it to be worse a year from now. They expect higher employment a year from now. That could be dramatically influencing spending decisions happening at the household level, particularly for that bottom 90% that don't have as much in the stock market and aren't feeling that wealth effect, and are much more concerned about a negative income effect if they were to lose their job or had to take a pay cut at some point in the next year. But we're also seeing fewer workers quitting their jobs. There's a quits rate number that's tracked by the Bureau of Labor Statistics that's showing that month after month, with a few bounces and wobbles here and there, the number of workers that are quitting their jobs is continuing to come down as workers feel less secure. And this, we think, is a forward indicator, has been historically a leading indicator for weaker income growth. And again, weaker income growth is going to mean less of a base from which consumers can continue to spend. Here's where the but is coming in. We have seen in the third quarter, and so far in the early days in the fourth quarter, better than expected economic data. The expectation, especially coming out of Liberation Day and the tough sledding in some of the markets and the economic data over the summer, early summer, as we've gone later in the summer, things have turned up. We have seen better numbers for manufacturing. We've seen better numbers for early indicators of capital goods orders, more businesses ordering things with the tariff uncertainty mostly in the past. And this optimism has led, as you can see on the next slide, economists to upgrade their forecast, not just for 2025, where we learned that the second quarter was a good deal stronger than we thought from a GDP perspective, but also for 2026. So we've come almost full trip in the 2026 forecast, this blue line here, from the beginning of the year where people saw it as about a 2% kind of trend growth year. We went all the way down to 1.4%, considerably below trend, and we've now come back up to around 1.8. Also for 2025, we haven't quite round tripped. We're not going to get back to that 3% growth year because the first quarter was negative, but we are inching back up as the economic optimism, and that's certainly tied up in what the stock market's doing as well, continues to improve at the margins.